Hello and welcome to MoneyCast, the monetary podcast from AAS Economics. Today we discuss 2022, the year ahead, and I'm joined by Dr. Frank Shostak, Director of AAS Economics. Welcome, Frank. Today we first discuss the US bond market. Frank, where do you think US government bond yields are heading in 2022?
Well, thanks, Derek. After closing at 0.53% on July 2020, the yield on the 10-year US Treasury bond climbed in early February to an excess of 1.9%. The question now is, this is the beginning of a new uptrend in long-term yields. Our model raises the likelihood that this could be the case. We also suggest that the key factor that the market reacts to is the Fed's likely monetary policy in the months to come. For the time being, Fed's buying of assets remains buoyant. The Fed's balance sheet stood at around 8.8 trillion at the end of December. And also note that in August 2019, the balance sheet stood at 3.77 trillion. So in other words, in December, in comparison with 2019, had an increase of 132%. A major factor remains at present with the market is the so-called price inflation. That's what the market is concerned. The yearly growth rate of the Consumer Price Index, the CPI, jumped to 7% in December actually, and in November it stood at 6.8%. So we observe quite a massive increases in the momentum of the Consumer Price Index, and that's really what worries the Fed officials and also the market participants.
So Frank, with inflation, what do you think will happen this year?
Well, many commentators now of the view that this increase in the momentum of the CPI is for all sorts of reasons. Some of them continue to talk about the supply aspect because of the COVID. Some others are blaming corporations, greedy corporations that are trying to make profits and they're pushing prices higher. Now, nobody says anything about money supply. And we are of the view that without the key factor, which is again the money supply, which determines the prices of goods and services, it is not possible to have a general increase in the prices of goods and services. And the yearly growth rate of our monetary measure, which for the United States, the AMS, jumped to 79% in February 2021 from 6.5% in February 2020. This constitutes an average increase of 43%. Now, if you allow for the time lag from changes in money and changes in the CPI, it will not surprise us that the momentum of the CPI displays a visible strengthening. And we are seeing that the massive monetary pumping by the Fed has generated strong demand for goods and services. That's really what happened, because the Fed has pushed money and people got a lot of money in their pockets now. The infrastructure, we suspect, is not capable to accommodate such a massive increase in the demand, and on account of massive monetary pumping. So this basically has further undermined the flow of savings, and this in turn has undermined further the expansion and the enhancement of the infrastructure. As a result of this massive increase in the demand, coupled with an unchanged supply, this was instrumental in the upward pressure on the prices of goods and services. Now, given that the price adjustment on account of massive monetary pumping is not instantaneous, and coupled with an unchanged supply conditions, this resulted in goods shortages at the given prices. So in other words, if for the market to clean up or clear up or remove the shortages, there is a need for a further strengthening in prices. And this is what we expect, probably more increases in the momentum. And based on our model, we expect that the momentum of prices is likely to strengthen until mid or even year end, before a visible decline likely to emerge later this year, or perhaps early 2023. In other words, we expect further rises in the yearly growth rate of the consumer price index. If somebody would ask for numbers, it will not surprise me that we may surpass the 8% mark. It could even jump to 8.5%, even higher. Now, given such a high numbers, this will create fear or problems for the Fed's policymakers.
So given the outlook for inflation, do you think that means that economic activity will also strengthen in line with inflation?
Yeah, that's what most people or conventional wisdom believes, that the increase in economic activity should drive price inflation. We don't think this way. We reckon that economic activity, the real economic activity at least, is driven by the state of the pool of savings, which funds economic activity. We don't share the view that printing money can push or can strengthen economic activity whilst the pool of funding is not there. So our view that the pool of funding or pool of saving displays a visible weakening, and this by itself doesn't bode well for economic activity ahead. Also, if one looks at the so-called GDP performance, and most people are mesmerized by GDP, and in fact it shows visible strengthening at present. We suggest that this is a misleading indicator. It's basically a reflection of monetary pumping, and which means basically that the GDP, strong GDP in inverted commas I would put, is basically a reflection of more bubbles. So we measuring bubble activities, and misleadingly or mistakenly we label increase in bubble activities as an increase in real economic growth, which is of course not the case.
So with elevated price inflation and a slowing economy, albeit from relatively high levels previously, how do you think the Fed will react?
Well, we hold that a weakening in the pool of savings leads to a weakening in the process of wealth formation. And this, in turn, works towards raising individuals' time preferences, which means an increase in the underlying trend of interest rates. Because once you have less wealth, obviously your tendency to commit yourself towards future shrinks, and you basically live at present. Your planning horizons shortens, and so this uptrend in the underlying movement in the long-term maturities rather than short-term maturities is likely to be more visible. Now, I suspect that the uptrend in rates likely to consolidate, regardless of whether Fed officials are going to trim the assets buying or not. because damage already been done, and the Fed officials would like perhaps to delay as much as they can the decision regarding the so-called monetary stance. But my view is that the Fed would try to delay again as long as possible, and will try to keep the current federal funds rate target at unchanged figures or figure of 0.25%. We hold that Fed officials are well aware that the visible increase in interest rates could spark a massive economic earthquake, given that the economy is severely misallocated, given all the bubbles that were created. And so any even tiny increase in interest rates could burst the bubbles and could be devastating. So from a political point of view, it will be quite difficult for them to do things. Although they will be forced to raise interest rate, are they going to do it? This will be a problematic issue for them. And also given the fact that we're talking about massive budgetary issues here, given that the government would have to pay a much greater amount of interest, and the outlays on interest could be massive. And so the question now is, can they afford such a thing? Any increase in interest rate would mean increase in interest outlays, and this, of course, most likely will be monetized. That the Fed will pump the money, and so it basically will end up in a counterproductive situation. Instead of tightening, they actually will be engaged in pumping more money. So the Fed is in a very difficult situation right now. The ideal situation for them is basically to raise interest rates significantly and create a massive bubble, a massive burst in the bubble. But obviously, politically, it is not going to be accepted. And they're running a risk of having immediately a very serious recession or perhaps depression. So they're well aware of all that.
Moving now to the outlook for stock markets. The US equity market has performed extremely well over the last 3 years, even despite the lockdown and the pandemic. In 2019, the S&P 500, for example, rose by almost 29%, in 2020 by over 16%, and last year by almost 27%. What's your outlook for the stock market? Well,
first of all, in terms of the so-called fundamentals, it doesn't look right at all. Most of the stocks seem to be severely overpriced. The so-called fundamentals, very difficult to establish what is fundamentals right now for some companies and what is not. Some companies that used to pay or still paying dividends might not be able to do it in the future, given that in one day, a company like Facebook collapses by $25 trillion. That shows you that we in the different world right now, that we didn't experience it before. My personal view that very difficult to establish who is what company is good and which one is suspicious, and that's on account of the fact that or the central bank has created massive monetary balloon, massive monetary bubble. So most of the companies we are assessing right now are based in the framework of the balloon itself, and as long as this balloon is still in existence, the various companies will supposedly show good performance. But given that our monetary indicator, the monetary liquidity or liquidity indicator, displays a visible decline, this this raises the possibility that the balloon will start shrinking. And once it will happen, it's already happening perhaps, various surprises in the stock market could emerge. Various good companies, which we thought they are good, may suffer, right? So, and this is still yet to come. Just to give you some indication regarding the so-called valuation indicators, like the Schiller price-earning ratio, it stood at 40.2%, 40.2 in early January against 34.5 in January 2021. Now, the dividend yield on the S&P 500 fell to 1.2% in early January from 1.5% in January 2021. So again, so the state of the stock market, I would say again, will be determined by how soon the Fed will tighten its stance, and the officials in the Fed well aware that if they were to tighten the interest rate stance, they're running a risk of a plunge in the stock market, which they wouldn't like at all, because for one reason, they are of the view that the so-called wealth of individuals is determined by the value of stocks. So the moment the wealth will start shrinking, the people's ability to spend money will follow suit, and then the whole thing will fall apart according to this way of thinking. In other words, they think in terms of demand creates supply, the Keynesian framework. Regardless of the framework right now, this will definitely burst the bubble, the whole thing, and we're going to have a serious problems. As a result of the fact that the bubble could burst, there could be shrinkage in monetary liquidity, and which means that cash could disappear. And in order to stay solvent, people will try to sell various saleable assets. One of them is, of course, the treasury bonds. And as a result, the treasury bonds could actually suffer during this particular episode, once the stock market are falling. And so the prices of treasuries could fall as a result of that, which means yields could rise.
Okay, moving on then to the US dollar and gold and the outlook for those. Gold has historically been viewed as an inflation hedge, but last year the price of gold fell by 3.6%. Where do you see gold going in the coming year?
Well, based on the increase in the price inflation, I would have thought that gold should have been much higher by now, much higher than it is right now. So one of the factors is, of course, I think one of the factors is that markets are still of the view that the Fed somehow could manage things and will reduce the inflation. The other is that people are still not relaxed still about the massive risks that we observe right now in the world. So at present, my view is that the gold does not reflect properly the so-called fundamentals. But again, the market does what it's doing, and nobody can try to overrule it. One can say that the market at the moment is maybe wrong, or people in the market are judging it incorrectly, but that's not my position right now. As far as the future is concerned, I suspect that our liquidity measure or our monetary analysis do point towards a possible reversal in the momentum of the price of gold, and we could see quite a strengthening in the momentum from monetary perspective in the months ahead.
And the US dollar. The US dollar strengthened against major currencies last year, such as the euro and the yen. Do you think that trend will continue this year?
Now, when we analyze currencies, we're looking at the money growth differential. In other words, we are saying that if a particular country prints at a faster pace its money versus other monies, then the currency, after the time lag, its currency will suffer or will weaken. So based on this, we are of the view that the momentum of the currency growth, the currency differential between the US dollar and the euro moved now strongly against the American dollar. So for at least for this year, we see quite strengthening in the momentum of the price of dollar versus euro, which means that the chances for weakening in the American dollar are very high during this year. All this could reverse in 2023, but that's what we see right now.
Frank, thank you very much for those comments. If viewers would like to see more of our research and perhaps get a free sample of some of our reports, please don't hesitate to contact us at info@aasecon.com or drop into our website at aasecon.com and complete our contacts page. We'd love to hear from you. And as always, we do appreciate comments, feedback, and questions from viewers. Thank you very much.